Alrighty, folks, as we have been discussing for the better part of a couple of years now, something we need to follow each and every Thursday is weekly unemployment claims. And as of this morning, we had one of those whoopsie doopsies, kind of a spike. It is not yet concerning. Again, we have seen weekly gyrations in these numbers before, but again, it's a yellow flag. It is something that we need to watch next week and the week after. We need to see if the trend has been broken. For the longest time, we have seen weekly unemployment rates come in right around 220,000 plus or minus a few. This week, expectations were for another repeat of 220,000. Came in at 242,000. 242,000. So again, we have been here before. We were here actually in December. We had one spike, I think it was in September, maybe August, where it was over 250. So again, yellow flag, something that we need to watch to see if we have a growing trend. If we step back and we look at continuous claims, again, this is my fear for 2025. Again, the unemployment rate, in my view, doesn't spike out of control, but we will see longer duration on unemployment. So we should be also talking about continuing claims. This week, continuing claims were down slightly. Going out to 3 decimal points, last week was 1.869. This week, 1.862. So down about 70,000 or so. We will talk about that and more, but I do want to let you know that I spent a bunch of hours yesterday loading the ORAT replay. Folks, if you bought a virtual ticket, if you bought a physical ticket, I have loaded all the videos. I have added all the people. All you have to do is go to Teachable. If you go to my Teachable account, you will see the replays. 307 names were added. I used the email that you registered on Eventbrite. So everyone should have access to the replay. Some of you have said, hey, I heard it was a great event. I want to buy it. Great news. Same price. I didn't raise it. If you would like to buy the replay and hear from Graham Stephan, the uneducated economist, and all the other wonderful speakers, Fred, Dr. Jeff, Jason Pritchard, all those folks, the link is above. I will put the link below, but you can go buy the replay for only $99. I will be loading some bonus content. My team recorded about 30 podcasts. I just simply didn't have enough time yesterday to load the podcast. So you will be getting additional bonus content. But it was important for me to get the replay up and frankly exceed your expectations. Once again, I had told all of you that it would take 3 weeks. Thankfully, we got it done in under 2 weeks. So hopefully you enjoy that. Do me a favor. If you did go to the event in Vegas, drop a comment below about which speakers people should go back and re-listen to. Maybe it was your favorite talk. Maybe it was one you missed. But let people know what sessions they should go talk to, because we had so many great people share amazing stories hopefully hopefully you enjoy it. Hopefully we exceeded your expectations again. We did have a bunch of earnings yesterday. NVIDIA probably being the most important. They beat top line, beat bottom line. They actually showed an impressive year-on-year revenue growth of 78%. Again, going quite well. Beat expectations by about 2%. Salesforce missed on revenue, beat on earnings. Again, revenue, you could think of software license sales. Earnings is profit. You know, how much money they make per dollar. But they gave a very weak forecast. eBay also gave a weak forecast. Snowflake beat top line, beat bottom line, and growing. Anybody else? That's what I noticed for earnings. I do think it is time for us to start talking about what is the bond market telling us. We have seen the bond market now for the last 7 to 10 business days take rates lower, and take rates meaningfully lower. I mean, as of yesterday, I haven't checked this morning, rates are down about 50 basis points on the 10-year. We are now starting to talk about yield inversion, or an inverted yield curve. In fact, yesterday, I didn't check this morning, yesterday the yield curve was inverted on the 3-month and the 10-year. As of yesterday, the 3-month was 4.32 and the 10-year was 4.26. How can I borrow money cheaper for a decade than I can for 90 days? This is what a inverted yield curve is. It is a often quoted sign of an impending economy slowdown. And I have to tell you, I think that's what the bond market is telling us. I think the bond market, the smart money, is telling us, frankly, it's telling us that inflation's not a concern, but a growth scare is. It's either telling us that, right, growth scare, not inflation, or it's telling us that the Trump administration is going to be successful at bending the curve on the runaway national debt. Frankly, it could be telling us both, but I wonder which one it is telling us. And this all comes at a time where the Fed, I have some Fed speak here for you in a moment, where the Fed is telling us that inflation is front and center. For example, Fed President Schmid concerned about recent increases in inflation expectations. Again, you got to remember that these consumer, expectations reports are not scientific. You have to remember that the average consumer understands the economy at a shallow level. And I suspect, like I've said in the last several days, that the average American is hearing the word tariff and translating tariff to taxes and taxes to more inflation. I think that is how you have the largest increase in inflation expectations since 1997. And I think that's going on, but that can be reversed. That certainly can be reversed. Consumer psychology is fickle that way. We could see in subsequent reports where that expectation is reversed. We shall see. Also, Fed President Schmidt said, focus must stay on inflation to protect the Fed's credibility. Fed President Barkin out talking about the target. The optics of moving the target from 2 to 3% would hurt credibility. Barkin also says we must get used to higher mortgage rates like 05, 04, and 05. So again, pretty interesting to think about. We did get a super chat. Let's check and see what Chester has to say. We're discussing possibly having a quarterly or semi-annual regional meetups in our accountability groups and what apps chat, keep the momentum going. I think that'd be a wonderful idea. I think if my accountability groups inside school start to do that, let me know. I'd love to send some swag or autographed books to encourage that. I would love to see the ORAC community continue to grow, share, inspire. My measure of impact now is who is in school, right? The school community is important to me because it's a show that our healthy group is growing, that we are supporting each other. We are bringing on new folks. So if I could help in any way foster more kind of regional based meetups and the like, just reach out to me. Let me know. I fully encourage that. Bloomberg is out saying that inflation measures are heating up again. This is the whole dichotomy. Is inflation going to rear its ugly head, or are we going to have a growth scare? Or worse yet, could we truly have what Anna Kelly has been talking about for about a year, maybe even 18 months, stagflation? Could we be in an environment where inflation is a problem and growth is a problem? Talk about the boogeyman and the fear of the Fed. That is it. But back to Bloomberg. Bloomberg is saying input costs are rising, inflation expectations are rising, and we are having wage growth. Kind of the triple whammy for inflation to be a problem. A couple of data points that I think are interesting. Highest level of completed homes. We did get new home sales. I think it was yesterday, which was a huge disappointment. It looks like completed homes are the highest since July of 2009. What does that mean? Frankly, it means builders are going to have to eat margin. I think it was Lennar might have said pace over profit. That just means credit, buy downs, lower prices, all of that. You will see home builders react quickly. Looks like President Trump is talking about tariffs on Mexico and Canada, plus an additional 10% on China for good measure, going into effect March 4th. March 4th. Now, again, is this more negotiation like the last time where they got 10,000 troops on the border of Canada and Mexico? Or is this just a sign that tariffs are going to be that new revenue source, and we need to get ready for that? So again, interesting stuff to look forward to. Q4 GDP came in at 2.4%, slightly better than expected, 2.2. U.S. durable goods, surprise to the upside, was expected to be 2%. Last month was negative 2.2, came in at 3.1. I do want to thank somebody for joining school yesterday. Shout out to Wayne. Wayne, thank you for joining school. Again, school, folks, if you don't know, is the place where my focus is. It's how we take the goodness of our ORAD event in Vegas and we keep those positive momentum going. Lots of free education and masterminds and all of those things. So again, if you have any interest, you want to be part of a community that is all going the right direction, you need to sign up. You need to join. Again, the bond market is something I've been thinking about a lot the last couple of days. Are we going to have that inflation scare, or is it going to be a growth scare? And again, people right now are talking about more and more rate cuts. For example, Morgan Stanley this morning said the 10-year could be on a accelerated path to 4%. What does that mean? What does that mean if Morgan Stanley is right? Well, let's just play it out. Let's say the 10-year note gets to 4% in July. Just pick a date, June. I don't care. For all I care, pick March. Just pick a date. And then if we step back and realize that the spread on the mortgages right now, I think are sitting at 260 basis points. That means mortgage rates might be 6.6, but let's be real. I think what also happens is the spread comes in and we might have mortgage rates at 6.25. If we have a par rate of 6.25, that means FHA, VA loans probably in the low fives, probably means conventional could get to the fives with less than a point. So again, if we truly go into a growth scare, we could have mortgage rates below 6.5. And frankly, if that happens, my 7% mortgage call for the year is going to blow up and look horribly wrong. But hey, it happens. I'll own it if that happens. The last thing I wanted to talk about is pending home sales. Pending home sales just came out at 7 a.m. I'm going to look it up on my phone. Ooh, an ugly number. Looks like U.S. pending home sales were negative 4.6%. What else do I got? January. And then why does it have two different numbers? Let's check these numbers. Yeah, negative 4.6%. Forecast was down slightly at 0.8. Again, down 4.6. This is what we're seeing, right? We have talked to Beth, we've talked to Adrian, we've talked to Jason. A lot of real estate agents are telling us that February was slower than January, right? There was a little pent-up demand post-January, right? The Trump bump, the known knowns, if you will. But now February has come in lower than expected. This is kind of why I keep saying that 2025 is going to be the last hard year for real estate transactions. And it looks like that is continuing. So, folks, at the end of the day, if you bought a virtual ticket, If you bought a physical ticket, you can now go to Teachable, log in with your login or your email, and you can watch the replays. If you have heard about the event and didn't buy it, you can buy the replay. Congratulations, for the same price. I didn't raise the price, still $99. Every presentation I thought was amazing. You will undoubtedly have your favorites, and I look forward to hearing what you think. I put the link in the comment below. I don't know if links stay active during the live stream. I will put the link in the description. It'll be the only thing in the description if you want to go buy it. All right, folks, take care of yourself. That is the daily financial news. We will talk again on Sunday. Bye.